Welcome to DeFi by Design, where we talk all things blockchain and cryptocurrency while striving to educate, empower, and enrich.
It's your boy Andy, and welcome back to the DeFi Slate YouTube channel. Smash the like button on this video, that really helps us out, and sit back and enjoy the content. Thank you very much.
What's going on, guys? Welcome to episode 61 of the DeFi by Design podcast. Beautiful day out here today. Looking forward to chatting about what's going on in DeFi in terms of risks, insurance, what is being built for the institutions to come and steal all of our yields, how we can protect them from getting rugged like Mark Cuban did, which, as a matter of fact, Mark Cuban came in and talked about DeFi for like 3 months straight, got rugged for like 75K, which is like pennies to him, and then left and now is a crypto hater. So we need to be able to stop that from happening and be able to protect our investors. And we do have a lot of that here at DeFi Slate with our education. We promote a lot of quality products. I think there's only maybe been one project that we've been interacting with that's actually had a really, really bad outcome. So we have a pretty good track record here. And I think that's a big part of it. And then another big part of it is using that education to build protocols like InsurAce, who we have on today with Dan, who protect crypto investors with effectively smart contract insurance and other risks insurance. So today we're going to talk about what the risks actually are in DeFi, what they are, how you can protect yourself from them, some of the good parts and bad parts of the current insurance protocols in DeFi, kind of the evolution of DeFi insurance. And what's going on at InsurAce, what Dan's building, and kind of his vision for building a more protected DeFi ecosystem while maintaining the openness and transparent architecture that make it so powerful. Excited today, of course, here with Rob as well and Dan. So let's kick it off, Rob, and get started.
Yeah, man. Yeah, I see the decentralized nature of DeFi and cryptocurrency as kind of opening a new world for insurance. How insurance kind of spreads the risk across multiple market participants rather than concentrating it in someone. This risk is kind of transferable, and even more so and in more creative ways with smart contracts. So I'm keen on kind of hearing more from Dan on how InsurAce spreads risk and ultimately makes DeFi safer for everyone participating on chain. So I'll kick it over to Dan and let him introduce himself and everything going on over at InsurAce.
Sure. Thanks, guys. Thanks for having me. I'm Dan Thomson, the CMO at InsurAce.io, the DeFi Insurance Protocol. We have been going since about April last year when we launched our mainnet onto the Ethereum network, and since then have deployed on Binance, Polygon, and Avalanche. To date, we now cover 15 different public chains and at least 95 different protocols on those chains. So we're one of the fastest growing DeFi insurance protocols, having covered over 200 million worth of assets in the last 9 months. And it looks like this year is going to be even better than that. So it's been rapid growth. It's been a crazy sort of 9 months since our launch. To sort of go through the basics of how DeFi insurance actually works is that exactly that. It's a decentralized form of the traditional insurance model where you have a significant capital reserve backed by a decentralized community of stakers, miners, capital reserves, premium returns, and investment returns, which is then used to collateralize the risk against any sort of losses incurred in your DeFi activity. So, for example, if you were to have, let's say, $100,000 in a particularly tasty beefy finance vault, earning your very happy 30, 40, 50, maybe a couple 100% APYs, you come to us for around 2.8, 2.9% APY and insure that risk against smart contract hacks, bugs, vulnerabilities, and any other losses like that. We can go one step further. You could take something like Anchor Protocol on Terra, earning you a nice happy 20%, 19, 20% returns on your UST stablecoin. So a fairly, decent return given the fact that in a traditional savings account, you're probably getting 0.5% at the moment. So you're getting your 20%, and you come to us, and the two risks there are the UST depegging and the Anchor protocol itself getting hacked. So you've got depeg event and a smart contract vulnerability there, and those two could be insured together for around 4%. So you're still walking away with 15, 16% APY, pretty much fixed guaranteed return in a crypto investment, which for us little degens sounds small, but the big institutions who are looking at 1, 2 to 7%, to suddenly get up to 15, 16% guaranteed fixed return in crypto is gold dust.
Yeah, that'll rock anybody's socks off who's above the age of like 35 without any DeFi experience, especially the insured part. I mean, that's like we have a lot of people who are interested in DeFi, and they're particularly interested in the stablecoin yields. That's like, that's what people are like really passionate about, who aren't, really too interested in investing in like the upside or taking the downside. And they're always like, what's the risk? What's the risk? But when you basically have insurance, I mean, you can never say no risk. But you're able to cover your ass kind of, and I mean that's like the next step for DeFi is making it up to par with almost like the FDIC, if you will, type of insurance. So you touched on two main risks briefly there. I'd love to kind of hear your list of like the most common risks or reasons for exploits in DeFi. And just maybe a brief explanation of some of the more prominent ones.
Sure. So yeah, I mean, the main one we cover is smart contract vulnerability. This is if there is a bug or a hack on a particular smart contract that siphons off your funds from your wallet account and your staked funds in that particular protocol, that siphons it off to a different wallet address. That would be the main one. The obvious other one is the smart contract depegging event, which is if a particular stablecoin, as we know they fluctuate slightly, happens to lose more than, say, again, depends on which one we're looking at, more than 11, 12% over a 10-day average period. So, those two are the sort of main events that we have. And these are two specific events that we currently cover. However, you're right. One of the biggest risks, one of the biggest concerns for a lot of big investors coming into the space is the risk of, any sort of vulnerabilities in code, in everything, like I said earlier, from getting rugged. So there are a lot of different aspects that we are also working on and towards, and a lot of other insurance protocols are working towards as well. Everything from Nft Insurance. I mean, we saw the accidental sale of a Bored Ape last week for
3 ETH or something. Yeah, they meant to put 300 ETH, and then they put 3 ETH. And then some bot instantly, just within seconds, a bot just bought it.
Yeah, so I don't think that would technically be covered, but there are examples that could be covered. Everything from flash loan attacks to rug pulls to private key losses. All of these down the line are things we'll be looking at doing. Even market volatility. So these are all different insurable events that we're working on products to solve. At the moment, we're focused mostly on smart contract vulnerabilities and bugs, and the stablecoin depeg with upcoming rug pull insurance and Nft Insurance. And we focus on these because they're a lot more objective. It's easy to see, for a user when they've had this happen to them, to show that this has happened. It's very objective. You can see the code very clearly. You can see that your wallet address versus the hacker wallet address. Easy to get confirmation from the protocol itself that this has happened, and therefore easy to submit the proof that shows. So it's very easy for the community to vote on whether or not to pay out or not. And I mean, the stats themselves are enormous. You're looking at an industry that, it's DeFi. Any given day, somewhere between $200 to $300 billion TVL right now, which is enormous considering it was nowhere near that a year ago.
So crazy.
The actual growth is insane. And even then, you look at the hacking figures. So in 2020, the DeFi hacks totaled around 120 million. Last year alone, were 3 billion lost in hacks in DeFi. So the space there is, enormous. And when you actually look at the total value that's even insured, is somewhere less than 2 to 3% of the total value locked in DeFi. Now, a lot of that value is locked in protocols that are theoretically uninsurable. too risky, just too much value locked in them that's not there. But, so it's a huge addressable market for the insurance companies to take care of. And so right now it's just about increasing the adoption and awareness that these solutions are there. I mean, again, most people in the space right now are happy to ape into anything and just throw money at something, and all we care about is every last percentage we can squeeze out of every possible game, which has been the mentality going for the last sort of few years, and probably might be for a little bit longer. But as we're talking about, as these institutions start coming in, as these financial advisors do start suggesting safer ways to invest in the space, as they start looking at better ways and smarter ways to invest in the space, we do start to come across, things like solutions like insurance that do, really start to make this a more sensible investment. Still on the riskier end, but there are better ways of doing it. And one of the biggest concerns for adoption right now is that it's not a part of the narrative. When any of us look at any new protocol to invest in, we look at, does it have an audit? Does it have a bug bounty? Does it, is the team good? Are the investors good behind it? One of those checklist points should be, does it offer insurance? And It's not a negative on the protocol itself. It's not I don't think it's one of those things that should be seen as a negative. Oh, it's offering insurance. It thinks it's going to get hacked. Yeah. It should be, look, these guys care about their users. They care about security. It's just one extra layer.
Yeah, and part of that checklist, I think, is being able to have your team implement all of the things that you mentioned, plus some others, like having locked liquidity, from the start to prevent a rug pull by the team, or having you can burn the admin keys, right? But even though that might give you a little bit less power, the multi-sig kind of setup. So we've made large strides, in terms of teams creating the most optimal security measures to start, and then you pair that with the checklist that you mentioned, plus insurance, audits and all that stuff. I mean, we really came a long way. But clearly not long enough yet, as we've seen so many hacks. Have you been a victim of any hacks in DeFi or any rug pull? I mean, I'm sure you've been rugged, but any exploits that are notable, or if so, I would love to just hear about that experience. And I can share one too if you don't have any notable ones, because for those of our listeners who haven't been rugged or hacked, it's quite the experience to log into the protocol and just see the thing draining, and you're just like, well, I don't know what to do. I don't know which account to remove the permissions from. Like, holy hell.
Personally, won, but I mean, I should have seen it coming. It was one of those really stupid investments where I just threw in some gambling money just for the sake of, it had a funny name. There was absolutely, I deserved to lose every penny I put into it, so I didn't really worry too much about it. But nothing too heartbreaking, luckily.
Yeah, and I think someone who is entering the space after the whole meme coin craze doesn't really have the experience of a lot of these projects are from anonymous founders that are doing it, maybe not maliciously, but they have the opportunity to be malicious. And when it's a 14-year-old in their mom's basement, and they have the admin keys to a few $1 million on chain, that might just be a bit overwhelming and too tempting for them to take the proper security measures. And it happens. It happens kind of in the malicious ways, which I think are a bit more difficult to protect from an insurance standpoint. But then also the vulnerability in the code standpoint, which we're seeing become less likely and less frequent with these audits. And we touched on it a bit as far as the ability to cover a lot of these hacks. I'm curious if it's kind of a one-to-one type of coverage. What I mean by that is it's let's take the UST and Anchor protocol bundle, if you will, and call it 4% or so to insure against that vulnerability. Is there a insurance writer on the other side of that? Gaining a 4% APY for writing that coverage, and then is on the hook for paying out, if in the case that vulnerability is exploited.
Yeah. So Now we approach different type of models for the decentralized insurance, and that is one, and that has been approached by a couple of protocols. So, on the one hand, those type of protocols will offer the per protocol insurance. So exactly like you were saying, you've got the insurance customer, and then the other individuals, decentralized individuals, who are willing to assume that risk on behalf of the APYs they can get from it. From our side, sorry, you have to excuse me, let's try and throw a cough.
Yeah, and maybe this ties into the decentralized model and how it can innovate on the traditional insurance model.
Yeah. So yeah, that's one approach definitely on the per protocol, allowing people to come in and offer the underwriting against that particular protocol. We do it per chain, so you can let's take Ethereum chain, you can drop in USDT, USDC, Ethereum, WETH, the Insure, all those different currencies. You can then basically the total amount that is staked with us with those different currencies is then spread across the 90 different protocols that we have on the Ethereum chain. So it's not like your particular exposure is direct to any particular protocol getting hacked. It's actually spread out fairly thinly, which means that in the event, it would take a massive black swan event of 10, 20 different protocols at full capacity to all get fully exploited, with all the wallets that we are covering being fully exploited, to really see a big dent in someone's staked assets. Whereas if you're directly staking against one particular protocol and that protocol were to be hacked, then yes, you are fairly on the hook for it.
Gotcha. So
Yeah.
the state InsurAce is kind of the backstop for the insurance payouts of these different hacks.
Relatively, it's one of. So actually, our main staked assets are things like ETH, BNB, Matic, AVAX. So we do have the big coins plus a load of stable coins in there as well. So it's not only spread across 4 different chains, it's spread across 6 different currencies in each. So even our pools are fairly well spread out, so that the payouts, it's lower risk from all angles in terms of the actual protocol itself, both for staker and insurance customer.
Yeah, and I think that does point to kind of the decentralized narrative of spreading more risk across the entire industry, and it becomes a safer environment for all. In the traditional world, there's kind of these insurance Goliaths, and they've been writing these insurance policies for, I guess, like 100 years, or if not more. And now in smart contracts and DeFi, it lends the opportunity to anyone to become an insurance writer and earn some of that interest.
Yeah, it's the same issue with big insurance companies and also big banks. At the end of the day, it's if you follow the money, you follow the insurance levels. I mean, they're all reinsuring each other, and after a while, you realize that the actual assets backing in the event of a domino effect aren't actually there. Same as banks, you can look at your bank account and it can say you've got $100,000, but actually they're only keeping 20,000 in reserve. The rest of it is off, everywhere else being used somewhere. So by having it all on chain, it makes it a lot more transparent, so users can actually see that their assets are protected and that there is enough capital available in the event of a payout, and everything's as transparent as it can be if they really want to look into it.
Got it. Yeah, having it on chain is quite nice. I mean, we've talked to so many people who are unfamiliar with, kind of how on chain works, and being able to just explain that you can look at everything on chain and see for yourself. That makes the insuring part quite a bit easier than doing things behind closed doors. And we've seen that with like. Anytime there's any sort of exploit, you always see the Etherscan link, and you can track where the funds are going. And centralized exchanges work to stop. Really, it's a team effort, in DeFi to make it, even just prominent community members do their best to step in and try to help stop the transfer of funds and exploits and stuff like that. I'm just a little bit curious on y'all's model for choosing protocols to insure. Do you care if founders are anonymous or not? Like, what is your vetting process, and specifically with regards to founders?
Yeah, sure. So we're extremely public about our risk assessment methodology. Anonymous teams we do deal with. Obviously, that is not a big red flag because obviously DeFi that accounts for a lot of teams. But we prefer obviously public teams, but we'll still deal with teams and look at the code independently, regardless of whether they're anonymous or not. So we do publish our risk assessment methodology. It's worth a look. It's akin to a kind of an audit, but accounting for teams, community, investors, a few other factors as well.
Gotcha. Yeah, there's been I guess more frequent rug pulls in the sense of these anonymous founders. Although the vulnerabilities, it seems more whether or not the code has been audited. And kind of getting back to, I guess, the instance when you may have been rug pulled, or if it was a hack from one of these meme coins, was there any precautionary measures that you could have taken that you didn't, or was it really just kind of being pragmatic and kind of assessing the risk of the investment you're going into, not really anything that can be done to on the protective side of things?
I mean, on my personal example, I think there was nothing I could have done. It was, I really did deserve to lose every penny in that one. Otherwise, yeah, I mean, any sensible investor would look at, the same sort of checklist that you can find online fairly easily. Look at the team, look at the quality of the reviews, the community, the social media, the quality of the social media accounts. If you don't understand the code, there's plenty of things you can look into. For us, we do look at audits, even quality of audits. I mean, I don't want to name any names, but some audits are better quality than others. There's a couple of resources for that as well, where you can see which protocols, or which auditors have had the most hacks on the particular protocols that they've been through. There's resources like DeFi Deal Apps Rect, where you can see various information like that. And then there's also DeFi Safety is a great resource. It's very, very good quality in terms of the sort of analysis they do on various projects. The better quality we get to, you look at like Masari reports and things like that. But yeah, I mean, in terms of you just investing into meme coins and like a really super early stage, yes, you're expecting to try and get some decent returns, but at the same time, they are slightly higher risk, which is, you should have factored that in.
Yeah. That kind of brings me to the thought of eliminating some of these risks through like permission to DeFi, almost, where we've seen Aave launch their Aave Arc protocol for institutions, basically KYC. Like they have still non-custodial and whatnot, but they're really helping them out with like their seed phrases through Fireblocks and using the Aave code only, stuff like that. I'm curious like what your vision is of like permission DeFi, if that's something that's probably going to grow over the next few years. Kind of what you see, if you're bullish on it, and just how does insurance and InsurAce kind of fit into that?
Yeah, sure. So it's all part of a wider, safer DeFi network, right? You look at everything from multi-sig wallets, notes to safe, to audits, bug bounties, insurance, even like companies retrieving lost funds. Oh, sorry. All the way through to any sort of KYC or AML recording. There's a few good identity token projects coming up. Lit is one of my favorite ones. Sorry. As well as
Lit
Entry. And Lit is like a Lit Entry. It's an Asian-based identity protocol. So essentially, the idea would be KYC yourself once and then use that identity token across the rest of DeFi. as a form of verification of identity, and no longer needing any sort of KYC everywhere else, which is in theory a nice idea. Whether or not it will end up being that or another one is still to be seen. But we're all working towards a safer space because we want the big institutions coming in, we want the big money coming in, we want people to migrate over from TradFi to DeFi. And by all these different integrations and working together, going full multi-chain, I don't think there's going to be one chain that wins out over the others. I think multi-chain is always going to be the way forward. There's always going to be benefits to different approaches, a bit of competition and different teams building in different ways. But then for us, like, the biggest step would be integration. So at the moment, it's a bit not too troublesome, but at the moment you have your stake somewhere. Could be Auto Farm, could be Alpha Homara. You then have to come to us to opt in for your insurance. You have to be on chain. You have to pay for the insurance through our app, selecting how much you want to insure and for how long. Luckily, we have a bundle cover as well, so you can choose all the different your entire bag. So you can pick all the different projects you're staked in and insure them all in one go, which can save you up to about 60% on your insurance cost and loads on your gas fees if you do it on Ethereum. But in the future, we're trying to move towards a sort of a one-click opt-in insurance where it's all done on chain at the point of your stake. You can opt into the insurance, a bit like a travel insurance that pops up when you book a flight. That would automatically cover you. And then beyond that, for the protocols themselves to list their APYs at a couple of percentage points less and automatically include that insurance into the APY coverage, so that you're getting covered automatically without even having to do anything. It's almost like a zero-click insurance coverage. You might be losing a couple of points of APY without necessarily knowing it, but those funds are automatically being sent over to the insurance protocol to make sure that your assets are protected.
Yeah,
and that would be the future. Just be simple, easy, integrated insurance.
Yeah, and that's potentially a community decision from the DAO of choosing to automatically opt in from the protocol level into that insurance, rather than kind of leaving it up to the user and even giving the user a chance of losing funds. After checking out DeFi Safety, they provide some credit rating in a sense of some different protocols, and it seems like right off the bat, doing something like a zero-click insurance where it's at the protocol level will boost up the safety rating of a protocol. And it seems like that's kind of where we're headed at on the protocol side as well as the individual side. If identity token is the way, we'll start to see kind of credit ratings of individuals on the individual token side of things, as well as on the protocol side. And I'm curious kind of how this ties into the kind of I guess, decentralized credit score, if you will, if you think that's kind of a meme or if you think that's really a potential solution to kind of the credit system as it exists today.
I mean, moving into a credit score, essentially looking at like a borrowing and lending against your assets, I think it's definitely a much more secure way of doing it, whereas the current credit system, depending on where you are, I'm guessing in the US, it's just built on credit, right? So you can take out 50 different credit cards and, with relatively little ease because they just want you in debt. It's as soon as you look in DeFi, it's almost, it could be used that way, but at the same time, it doesn't have to be because it's all on chain. You can see how many assets you have. You plug yourself into something like, 8board, and you can pull up any wallet's assets that, you want to have a look at. So would it work in the same way as sort of a credit score? I mean, possibly. You can pretty much do it now anyway. You just find a wallet address that you know belongs to someone and plug it into a few trackers, and you can pull up their sort of asset score. And would they be able to borrow against that? Yeah, maybe, but that's kind of what these borrowing and lending protocols are for. But I think that that essentially the majority of the traditional finance system is built on lending and borrowing. So it's just about making that as safe as possible for bigger and bigger money to come in.
Yeah, and we've almost seen DeFi solve for this already to a certain extent by keeping the lending and borrowing projects over collateralized. Yeah,
as we should, to be honest. We've already spun up enough debt, and we've already spun up a lot of crazy Ponzi-nomics. We're on 13 billion% APY OHM fork. So, yeah, I don't know, maybe give it another year or two until we start to get under collateralized loans. But with that kind of would immediately have to come the credit score that we're talking about. There's a project called Union right now that they're just launching. They're doing they're going to be, I think they're going to be huge, and they're basically doing the credit score. We had a conversation yesterday with some lads from a protocol called Swap, who's doing like a digital identity sort of kind of probably similar thing to the lit entry protocol. And basically, now that we're talking about credit score, I'm starting to think like you can have like all of your NFTs, all of your social media accounts, all of your crypto assets, your Ethereum wallets, all the DAOs that you're a part of, all your PO apps. You can even now have a credit score, all in kind of like this digital black box that is, that's you effectively. You can have the land that you own in that metaverse, all these things together to basically create your own digital persona that, that you own, tied in with your ENS and all that stuff. It's going to be really interesting when we get to the point where we are judging people's reputation based on their on-chain activity. Like, I wonder if going on Paraswap with a VPN and trying to get the airdrop, even though US users weren't allowed to do it, is going to, negatively affect somebody's on-chain reputation, or, doing things like that. Like, I wonder if we have to start to think about what actions we're taking on-chain, and what if you rug somebody with your address, right? There's obviously so many ways around it and such, but it's an interesting concept when it comes to like reputation and credit on-chain. And of course, insurance is all tied in there as well, based on, who you can pick to insure on that kind of scale. You start to play almost like a different game where instead of just insuring protocols, Dan, you could start to, help individuals almost based on their credit score or their reputation and such. It's just an interesting kind of vision that I've started to develop.
Yeah, I mean, as more and more assets start to be digitalized and ownership and the value of these gets increased, and then you get collateralized loans and any sort of like transfer, even just ensuring that against like cross-chain bridge insurance. It's another project. It's another one of the types of insurance we bring out, because there are risks with all of these things, and as people move into the space more and more, that and even then, as the space just evolves, who knows what's going to be coming out in the next couple of years. 15 years ago, if someone described the DeFi space to anyone, they'd think they're mad. So who knows where we're going to be in a few years? Who knows what? But there'll be enough value in it that there will be insurable assets and insurable events that will require us to be there. It's super exciting, no matter which way you look at it. Whether that's buying virtual pet insurance for your virtual dog in the metaverse. I don't know. It could be anything.
Yeah, and there ultimately, I think it creates a more, I don't know, I'm not really sure quite what the word is, but when Andy mentioned kind of like starting to judge people with their digital persona, it's people are already, they have their browsing history, and if that's exposed, you certainly become judged for it. I mean, if you saw the SEC report on like what some of these SEC employees are actually doing with their time, and the amount of time they're spending on porn sites other than finding effective regulation, that was quite surprising. And I think that's an effective judgment on, this is a public employee working for the government, and they're using their time in a much mismanaged way. Not to say that other people should be, controlling what individuals do with their time, but it does kind of shed light and expose some of the more, I guess, unsavory types of activities that people are spending online, and especially when that time is somewhat public, because it's a public entity that they're working for. It does start to shed a lot more light on kind of what people are doing online.
For sure.
Yeah, absolutely.
And it's different on chain. Back to kind of some of the insurance talk with regards to, the metaverse almost. And, you mentioned some of the NFT stuff. I'm curious what you think, like in the NFT world, To protect against something like that, like a noob selling their Bored Ape, 500 ETH below floor price or something. What are kind of your thoughts as far as protections in the NFT world when it comes to, I guess, just like arbitrage and just making simple UI errors?
Sure. Yeah, so there's a few different options here. So, obviously the Bored Ape sale last week, I think it's akin to private key loss, right? It's extremely hard to prove that it was, a genuine accident. If you lost your private keys and suddenly your funds were whittled away to, your mate Dave, whether or not it's public or not, it's hard to prove that that was a malicious attack or whether or not you just basically gave your keys to someone on a piece of paper at a restaurant and said, "Oh, take my money, I'm insured, I'll get it back."
Yeah,
right?
and so Andy and I actually lost all our keys in a boating accident, unfortunately. No, that's quite a meme. It goes back a while, okay, go ahead.
That's rough. I'm sorry for that. That's horrible. So that's one example. If you can prove, if there's a way of proving that, the same as proving that you undersold an NFT. The problem with NFT insurance, obviously, how do you value them? How do you get genuine value? Because in the way that my favorite sort of anecdote about NFTs right now is that, say you've got $1 million in Ethereum, you create your own NFT, you can sell it to yourself for $1 million in Ethereum. So now you've got $1 million in Ethereum, and you've got an NFT that's just been valued at $1 million. Now, say you sold that at 90% discount for, let's say $100,000 in Ethereum. You then sell it. Now you've got, someone else thinks they're going to buy it at a 90% discount. They're thinking they get a great deal. But at the end of the day, all you've done is generate yourself an extra $100,000 in Ethereum. Now, how do you, as an insurer, value that as, which is the right value? Is it the true value, which is next to nothing? Is it the 1 million that was originally sold at, or is it the 100,000 that was then sold genuinely on an open market to? So valuing NFTs at the moment is extremely difficult, which is one of the biggest holdups in having NFTs insurance there. I guess it's the same as sort of traditional art insurance, but there are, we are making headways in it. And we will be the first, people to actually offer NFT insurance in the market.
Yeah, there's definitely a job available for an NFT expert, although they might just be way too loaded to even care to work anymore. But the appraisal of certain NFTs is going to be huge. I think there's a project called Abacus now. If you haven't heard of them, Dan, you should totally check them out. They are doing NFT appraisals, and they were hiring and whatnot, and they're basically trying to just provide a platform for people to actually assess what their NFT is worth based on, several metrics, from rarity to previous sale to floor price to, look. So I think they have like a pretty good computer generated algorithm. And then I think they have like a human last call checker or something to that extent. So it's tough to price these things because to one person it might mean the world, and to the other person it might just be a JPEG. So it's definitely an interesting dilemma. But I've been finding that NFTs have been like the most uncorrelated market to anything in the world right now. Like with even how everything goes along, like the stock market, the housing market, the bonds, the Bitcoin market, and then you got the ETH and the altcoins and the DeFi. Like NFTs just kind of have a mind of their own, and they're just kind of, they just kind of operate on their own kind of whim due to like the illiquidity and kind of like the art nature of it. I'm curious what you think about the NFT market going forward in terms of basically making it more liquid, or perhaps making it more efficient and accessible in terms of gas fees, or in terms of like all these new projects being pumped. Just a brief overview of kind of some of the things that you've thought about the NFT world.
Yeah, NFTs they're incredible, right? They have their space. It's the technology is akin to, some of the fundamentals of DeFi and blockchain tech. At the moment, I think they're in the same sort of cycle as like the 2017 ICO craze. So obviously it's a lot of hype. I wouldn't invest in too many NFTs myself, akin to me going down the local collectibles store or like, antique store and trying to find something rare, because I know very little about most of them. That said, I got very lucky. I do own a Punk, so I'm extremely happy with my original crypto Punk, which has done me very, very well for now. I will be holding it through the crash if there is a crash, if I'm right about this inflated market. But I do think it's in a bit of a bubble. I think people should be careful. Like I said before, there are ways of generating value in these things that completely artificially pumped up for no reason, just to give someone extra cash themselves. Sorry, but at the same time, NFTs are the future. Digital provable ownership is something that it's something that's been missing from the world, and will continue to increase in value in the long term. It's like my favorite example of explaining NFTs to people is, how if you go to the Louvre and you see the Mona Lisa, how do you know that's the real Mona Lisa? How do you know that's not just a very good copy that even the Louvre puts out? Maybe they've got the real one behind, but I'm not a good enough expert. They don't let you close enough. They don't let you touch it, inspect it, do anything else. You could be looking at a very good fake. I mean, the real one might have been stolen a few years ago. We'd never know. It could be just another example there. And then adding on the sort of the provable ownership really does add the value to it.
Yeah, agreed. Punks are like the Mona Lisas of the NFTs, and Bored Apes are like the Jersey Shore. It's quite a funny difference in the community. I'm sure the Punks will eventually reflip the apes. It's only a matter of time.
And NFTs as a whole, I think are going to. I think you're going to evolve quite a bit. Like NFTs in a few years are going to look very different from the profile picture art pieces that we're seeing now. And, we're already touching on the identity tokens, and likely they, will be some form of an NFT, even though it may not be the visual type of art piece that we're accustomed to seeing as of recently.
Yeah. There's a lot of.
I mean, you take like you take like what was it? Eminem bought one over the weekend, right? So he bought a 460k Bored Ape, Mutant Ape, and that's it. I mean, as having like a digital identity for yourself, if he's going to use his Bored Ape for that, for the next 15, 20 years or however much, in the metaverse, if that's going to be his identity going forward, then great. But at the same time, my argument for celebrities is that they could literally just create any random basic avatar of themselves and say, this is my NFT, this is this is me. And ironically, that would probably then sell for the 400k afterwards, because he could probably turn around and say, oh, this is my NFT. This was the original Eminem NFT. You don't need to go and buy a Bored Ape to do that as a celebrity. But they're doing it. They've got the money. Why not?
Yeah, one of my I'm bullish on layer 2 NFTs. Mario Götze, a really good football player, just bought a small brand. I was pretty gassed about that. That's probably the coolest part, is like being in the same community as like some really famous people and seeing them come into crypto. It's funny that NFTs have done that. Today there's a Nas music drop NFT, a few hours. I think those are going to be huge. If you haven't looked into Royal, check out Royal. It's a really good music NFT platform.
Yeah.
Yeah.
So I mean, those kind of ones. I mean, those are the ones that are novel for now, but are a lot of those going to have any real world value in 6 months, a year? When something else comes along. That's the real hard thing to sort of stay on top of. I mean, I think there's a crypto event coming up where they're like, oh, you buy a ticket and you get an NFT minted. I'm like, no, who's going to value an event they didn't go to as an NFT ticket?
Right.
It's like. There's some real people just throwing the word NFT around just for the sake of it, which does give a few top signals in terms of a bit of a bubble. And I think a lot of people are going to come into the space thinking, reading all these big stories about people who have turned, a JPEG into a few $1 million. But there is real, good value and good technology behind it that in the longer term really will benefit the entire space as we move sort of more digital and more into the sort of more into the rabbit hole of crypto.
Yeah, I didn't really finish explaining, but I'll let my cognitive dissonance do the explaining, which is I'm already locked in. I'm minting, so I'm gonna defend my mint in that these new music NFTs are called limited digital assets. They're called LDAs, and so effectively what you get is you get a percentage of the royalties from like the streaming royalties from Spotify, SoundCloud, Apple Music. Every NFT holder, like the more you pay for this drop, the more of the royalty you get. So these, while they are a part of the, I agree, of like the hype, in essence, they could be argued as they're yield generating from actual real world value rather than like just an NFT project launching in ERC20. So I'm excited for these and, potential for good upside, but also like, I don't know, what is 0.05% or 0.1% of their royalty on one song? Probably not going to be huge, right? But it's at least something to justify a cash flowing NFT.
No, it's great. I mean, it's decentralized essentially ownership. I mean, in terms of like same again, instead of like a publishing house, instead of all the different shareholders in a particular company that might put a record out. If it's NFT style ownership, all these LDAs, that's a really nice way of spreading the benefit out amongst essentially investors, right?
Yeah, it's cool. It's new for sure. So we'll see how it goes. Yeah, I'm curious, man. So it'll be interesting. But wrapping things up here. First of all, thanks for coming on, Dan. It was an absolute pleasure. I know you had an epic trip to Antarctica, so that was pretty badass. I'm sure you're still recovering a bit, but anything that our community can do to get involved with InsurAce, recommendations, how do they get involved? How do they use insurance? How do they get covered before we kind of close it up?
Yeah, sure. No, thanks for having me. And yeah, slightly recovering still. We're here to keep everyone safe, right? So it's all about helping people invest safely, helping people make those returns without the downsides. So we educate people as much as possible. You can find our website, insurace.io. Find us on Twitter, Telegram. Our team are always getting involved, Discord as well. So you can ask questions, find out which type of insurance would be ideal for you, find out what the risks are. We do nice security ratings on each of the protocols we list, which should highlight some of the higher quality protocols out there. In our view, anyway, we list some of the big DeFi 2.0 protocols, including like Olympus, Abracadabra. So you can get some of those. We've got Wonderland on there. So the ones that really have a few 1,000% APYs that you can be getting for let's say 2 to 3% cost of insurance. You're really covering yourself from quite a lot of issues that could or may manifest. This year, it's going to be a really exciting year for us. Obviously, DeFi is just has a potential just absolutely moon right now. Huge amount of money coming into it still, and coming as an insurance protocol is great. We're just helping to protect those big institutions as they invest their assets into the space, which at the end of the day it should be everyone's goal. I mean, that's what we need. We need the big money coming in. It justifies what we are. We all do very well out the back of that. And it just helps the space to go to that next level and get more and more widely adopted, which as early adopters, as we all are, really does benefit us all in a big way. So that's why so many people are working on different safety measures to make the space as safe as possible. And that's why we're here. We're here to make people's DeFi journey that much safer.
Yeah, big brother.
Superman. Thanks for coming on. It's been a blast, and like we talked about it's really a team effort out here, building a safer community and a safer investment environment in DeFi, and ultimately bridging that gap to some real world value accrual through whether it's streaming in music and NFTs or it's artistic value. Building a transparent and open community that's also safe. And InsurAce is right on the forefront of that. Sweet man, thanks for coming on.